Well, we've just completed the most important week of earnings season, and markets are down, sentiment is low, and it's fair to say that fear and uncertainty has returned to the market. In today's weekly wrap, we're going to be unpacking many of the leading US earnings reports from many of the mega cap technology names. And make sure you stay until the end because we're going to be discussing some of these retailers and consumer focused companies that have provided us an insight into the state of the economy and where consumer confidence currently lies with the rising input costs, inflation, and of course the cost of living discussion. I guess before we discuss the actual earnings reports and the numbers themselves, it makes sense for us to take a bit of a discussion about the lay of the land. Where are things currently positioned? As we can see here, over the past week, the markets have retraced. The S&P 500 was down by 3.3%. The Nasdaq was down more by 4%. We had a big sell-off at the end of the Friday session, down by over 4%. This was led by Amazon with a weaker than expected forecasted guidance. AMZN was down by 14% for the single session. It's worth noting that just for context of how difficult of a month that April was, both Amazon and Google posted their worst months since 2008, which of course was the GFC. And the Nasdaq index itself also had its worst month since 2008. So there's been a lot of headwinds, and it's fair to say it's been a difficult start to 2022. Year to date, the S&P 500 is down by 14%, firmly into correction territory. The Nasdaq is down into bear market territory. It's down by over 20% once again. And the question is now, where do things head from here? For some of those other indicators that the market are watching, the bond sell-off has extended. The 10-year yield is up to 2.9%. The VIX, a measure of volatility, soared through the 30 mark, and it actually closed the week at above 33. It's worth noting as well that across many of the major indices, we've been testing and in some cases breaking through key support levels. And so there is a lot of uncertainty persisting throughout the markets. On that earnings front itself, we've now had over 50% of S&P 500 companies reporting. Around about a third of the companies all reported last week. So that gives you an insight into how important that was. And of course, in this mega episode today, we're going to unpack many of these key reports. So far, so good. Around 80% of the reports have beaten estimates so far, and there have been a number of key themes that have started to flow through as well. We know that there has been a strong and resilient consumer that continues to show itself and to stand up to the adversity of rising inflation and cost of living inputs. We have seen so far many of these companies have the ability to pass through rising costs without a significant destruction of demand. There have been concerns about forecasted guidance and of course what happens if inflation remains more persistent. And then it's also worth noting as well, this is a continuation of a theme that we've seen play out over the last 3, 6, and really for some cohorts of the market, 12 months, where we've seen multiple contraction, and this has continued on particularly throughout the more growthier end of the market. And so with that, there is a lot of earnings reports for us to unpack. This is a stacked weekly wrap episode. Let us know your thoughts throughout it with a comment, but let's get into it. Where else would we start other than with Amazon? AMZN had a significant sell-off to end the week. But Amazon also give us an interesting insight into the state of the consumer, but also the state of the cloud adoption with their Amazon Web Services business unit as well. As we talked about, Amazon was down by 14% in the single session on Friday, which really led the Nasdaq and the tech sector of the market lower. They missed on earnings, but a lot of the uncertainty really surrounded the weaker than anticipated forecast. For anyone who's been watching Amazon, we know that Amazon is a company that has always traded on a rich multiple, but the market has often been willing to pay for the growth because it has been a company that's really compounded growth significantly year in and year out. However, this was the second quarter in a row now where they put up single-digit growth. This quarter, Amazon recorded 7% growth, and they actually forecasted for the upcoming quarter between 3 to 7% growth. This is, for a bit of a context, the slowest growth for Amazon since the dot-com bust in 2001. So it gives you a bit of an insight into the scale of the slowdown. A few other factors with Amazon's report. AWS beat. This speaks to the theme of the strength of the cloud adoption. We'll talk about that with some of the other reports later on in this video as well. Advertising was weaker than anticipated. Another theme we'll talk about with Meta and Google. But Amazon also recorded a negative $7.6 billion loss on Rivian. For any fans of the electric vehicle sector, I'm sure you'll be familiar with the trends playing out for Rivian and some of those other players as well. It's worth noting that Andy Jassy, who took over as CEO from Jeff Bezos, stated that Amazon will now be focused on offsetting costs in the fulfillment network as things begin to normalize. Of course, Amazon have been investing heavily, like many other companies in the sector, so they're going to be looking to offset costs moving forward. Then flowing through, another company, another mega cap technology name that reported on the Friday session and actually was weaker on the back of it as well, was Apple. At that top line, Apple had solid sales numbers with revenue up by 9%. And it wasn't so much a demand issue itself, actually. Revenue beat well, it was up to $97 billion. iPhone and Mac revenue both shone as well. It was quite fascinating to see because on the iPhone front, we know that Apple has a more premium smartphone offering than some of the other players in the space. And this insulated them relatively well from the rising inflationary pressures that we've seen and for consumer confidence. But on the Mac front as well, this was the first full cycle with the M1 chips within the Mac. We know that they've in-house the production of their chips, and it was fascinating to see the consumers have quite a good uptake of this. Services revenue was around about in line for expectations, but it's growing at 17%, shows a longer term high margin opportunity that the services revenue business unit provides. But a lot of the concerns surrounded supply constraints. For Apple, like many of the other companies we'll talk about today, they reported that it could be as much of an $8 billion impact likely to be seen throughout this upcoming period. There are China uncertainties as well that will flow through in this quarter. And Apple, continuing on the trend like they've been doing throughout the past period, $90 billion in share buybacks announced. Bit of fun trivia for you. Apple's the public company that actually spends the most on buying their own shares. Sticking on the handset telco side of things, Qualcomm. Qualcomm obviously are a semiconductor player and wireless connectivity company. They actually beat estimates very well. Qualcomm actually managed to grow revenue on the year-on-year comps by 41%. When you're talking about a company with a revenue base of around $11 billion, it's not easy to keep growing at that pace, at that scale. Their chip sales made up around $9.5 billion of that $11 billion of revenue, grew even quicker than the total unit at 52%. And Qualcomm, which really attracted the market attention, was stronger than anticipated guidance at $10.9 billion versus around about a $10 billion consensus. Markets are watching for diversification for Qualcomm away from their handset and phone-focused business. We know that their Snapdragon has been a true beneficiary and a real success story, particularly on the Android side of the market, but they've highlighted opportunities within their smaller automotive business. Still only makes up around $339 million currently, grew in line at that 41% mark, but also their Internet of Things technology business reported 61% growth, and this is closing in on $2 billion, so it's a more significant component of their offering. Sticking on the chip side, Intel. Intel's another chip maker, a leading global player as well. They actually beat on both the top and the bottom line, but it was weaker than anticipated guidance that had the market a little bit fearful. Their PC chip business declined, and you might be wondering, why was that? Well, as we talked about with Apple, Apple actually brought in-house a production of their chips with their M1 chips, which were previously Intel. So with Apple in-housing these chips, the client computing group of Intel declined by 13%, which was below the consensus estimate. Bit of an interesting sentiment or takeaway here as well from the CEO, Pat Gelsinger of Intel. He stated that he believes the industry is likely to continue to see challenges until at least 2024 in areas like capacity and tool availability. So that's something to think about when we're considering the semiconductor space. Then on to Microsoft. Staying on the tech theme, Microsoft had a strong report according to the market. A lot of analysts really liked it. They beat strongly both the top and the bottom line. $49.36 billion in terms of revenue. Beat on that top line. This was an 18% gain year on year. They guided for upcoming quarter revenue of $52.4 billion to $53.2 billion. So you can see that incremental gain on the $49 billion from this quarter. Below the hood is where it gets really interesting for a company like Microsoft. Obviously, they've got a diversified offering, but looking at some of their core business offerings, the productivity and business processes segment, this is where their Microsoft Office is housed. This was up 17% to over $15 billion. And on the cloud revenue side, of course, Microsoft Azure is a leading global player. Azure and the other cloud services grew by 46%. And this speaks to the strong growth that we saw with AWS, and we'll see with some of the other business units as well as we talk about the rest of the companies. It's also worth noting as well that Microsoft in the past quarter announced the biggest acquisition in their company's history for Activision Blizzard, one of the leading global video game companies. They produce games such as Call of Duty that I'm sure you're familiar with, and this will be for around $69 billion. Sticking on the mega cap technology theme, Alphabet. Alphabet, unlike Microsoft, actually missed. They missed on both the top and the bottom lines. EPS missed heavily. Revenue came in weaker, around $68 billion. Top line revenue growth was 23%, so double-digit growth, solid, was weaker compared to the 34% 12 months ago. But if you're thinking about where this weakness actually came through from Alphabet, was in their YouTube business unit, where we're all watching and discussing this video today. This was actually weaker and far weaker than consensus estimate for Alphabet. Alphabet, of course, is the parent company, but consensus forecast was for $7.51 billion. However, they were able to put up only $6.87 billion, with YouTube ads following a familiar theme that we've seen with some of the other reports, and we also saw it with Snap as well over the past couple of weeks. Google Cloud, however, was strong for Alphabet. This was in line and follows on from what we've seen in the past, 44% growth for Google Cloud. However, it's still not a profitable business unit, so we'll watch the trajectory moving forward. Then following on to Meta. Meta is the parent company of Facebook. Of course, we know that Meta has really struggled over the past year. After what has been a really difficult past 12 months, low expectations, we know that they're around about 50% off from their peaks. After their report in February that I'm sure many of you are familiar with, their share price lost over 25% and was one of the biggest one-day sell-offs that we've seen in markets history. Meta actually added 17% in terms of share price on the back of a report that delivered a better than expected profit. Granted, there was a relatively low bar after everything that's happened. Daily active users actually rebounded to 1.96 billion, nearly 2 billion across the total offering, which includes, of course, Facebook, WhatsApp, and Instagram. Interestingly, a number of key metrics missed, which included sales, was only 7% year on year. This was the first single-digit growth in 10 years as a public company for Meta. So that shows that it's been a difficult period. Revenue was slightly weaker, though average revenue per user was slightly stronger at $9.54 per user. We know that Apple's privacy changes have affected a number of companies, and probably none more so than Meta themselves. But what's going to be fascinating about Meta, of course, is this has been predominantly ads focused so far, if you think about the significant component of total revenue that this makes up. But we'll continue to watch as a transition towards Web3 and the metaverse grows over this next decade and beyond. And then just thinking about this, a lot of these were mega cap technology name earnings, but we also know that inflation is a key theme right now. And investors, analysts, and economists have been watching for how well these companies that are consumer focused have been able to pass on rising cost pressures, rising input costs, and how well consumers have been able to digest cost of living pressures with a lot of these companies trying to pass on these rising costs. So far, we've got a few different insights from a number of companies. Many of these restaurants that we'll talk about today actually beat on both the top and the bottom lines. Often they've reported raising prices, as you'll see, though for many of them there was another theme as well that was interesting, where future inflation was highlighted as something to watch, particularly if it's sustained in future quarters. So just having a look at some of these companies here. Chipotle beat both the top and the bottom line. Margins were down due to rising costs for input materials, no surprise there, but they were able to raise prices by around 10% year on year and have so far seen very little resistance from consumers. Pepsi beat top and bottom line, lifted full year guidance for organic revenue growth. Convenience stores they've mentioned are seeing less foot traffic, but so far consumer behavior has not meaningfully changed yet. Coca-Cola, a similar type of company to Pepsi as we're all familiar, beat top and bottom line, same theme once again. Unit case volume was actually up by 8%. They reaffirmed the full year outlook, though they've highlighted storm clouds potentially on the horizon with inflationary challenges. And what they did highlight as well, that consumers won't be able to swallow inflation endlessly. So it'll be fascinating to see where we start to see some resistance and potential destruction of demand. And then McDonald's. Revenue topped estimates, they were able to raise prices. To give you a bit of an insight into this, in the US, the McDonald's menu prices were up by 8% year on year. And I'm sure if you've been to McDonald's recently, you've got a Big Mac or something else, you might have seen some of those raising prices and costs as well. I'd love to know your thoughts on it all as well. So drop in a comment below what you've made of earnings so far and what have been your highlights across the companies. So you might be wondering now, what to look for up ahead? Firstly, of course, we'll continue to watch for inflation, and as was mentioned by a number of companies, how will consumer confidence go, particularly if inflation persists? We know that this isn't the end of earnings season as well. Up ahead in the week, there's a range of leading companies from AMD to Airbnb, Starbucks and Shopify. But really, I think what's going to attract a lot of investors, analysts, and economists' attention over this upcoming week is central banks' decisions. We know that the Federal Reserve has got a decision on their hand. Will they raise at 50 basis points, which the market's pricing in? There's been some discussions of 75 basis points. Will it end up being 50? We'll see. But of course, closer to home, the RBA have a decision as well, ahead of the federal election. If you're interested in broader discussions about the macroeconomic picture, here's some other videos that you can check out after this one. A big thank you for joining us. For now, stay well and happy investing.